Walmart stock is down over 8% today. What are some of the reasons why this stock is going lower? And should you step in and buy the dip on this one? We'll talk about that and more on today's show. What is going on, investors? Hopefully, guys are doing well out there. It's time to talk about Walmart Incorporated, ticker symbol WMT. The company just reported their Q1 earnings before the bell, and the stock, like we said, is down over 8% during the regular trade. We are recording this with several hours left to go. We'll get into the earnings on today's show. We'll take a look at the revenue. We'll take a look at how inflation and costs are really impacting this company from a profitability perspective. We'll look at cash flows. We'll look at the all-important inventory, very important line on the balance sheet and the cash flow statement for Walmart. And then we'll look at this from a technical perspective. Is this 8% drop in Walmart shares? Is this creating a buying opportunity? We'll talk about that and more. So we jump into these Q1 results. Revenue came in at $141.6 billion. I don't want to just fly over that like that's nothing. There's very few companies, as you know, in the entire world that are producing that kind of revenue for a full year, for 10 years, for 20 years. This company happens to do it in 3 months. $141.6 billion worth of revenue. Last year, we were at 138. That was just a 2.4% gain, but most Walmart shareholders are comfortable with kind of that very low single-digit growth on that revenue side. They have experienced some growth in the last couple of years, especially in this membership to Sam's Club. That was up 11%, although we've seen faster growth rates in previous quarters. You get a blended growth rate of about 2.4%. Now, what unfortunately for Walmart shareholders is we got a little bit of an update from the CEO, and this is a quote from the press release. He says that bottom line results were unexpected and reflect the unusual environment. U.S. inflation levels, particularly food and fuel, creating more pressures on margins and operating costs than Walmart expected. The CEO goes on to say that they are adjusting and will balance the needs of their customers for value and the needs to deliver profit and growth for future shareholders. So we'll see evidence of that in these cost of sales. So we talked about revenue, 145.6. Our cost of sales ticking up 3.5% to about 107 or 106.9. So right off the bat, you can see when you grow your product sales by 2.3%, but your cost of sales go up 3.5%, that's a problem. You also have operating, selling, general, administrative. These are all the operating costs. Those are up 4.5% from 28 billion up to about 29. So our operating income, it went down. It went down quite a bit from about 7 billion or about 6.9 down to 5.3. That was a 23% decline on that operating income. Again, primarily driven by the fact you had higher cost of sales and you had higher operating costs as well. The company did reduce their debt in the most recent quarter. Some of it rolled over to the short-term side. We'll show you that when we get to the balance sheet and the cash flows. Come through the tax line and the interest lines, and you come all the way down to the bottom line, about $2 billion worth of net income. That was a 24% decline. On that EPS side, you earned about 74 cents per diluted share. Last year was closer to 97 cents. I'll remind you, the company pays a dividend of about $2.24 per year. You're getting probably north of about a 1.6, 1.7% yield on this one. Not necessarily what we would call a high yielding stock, but certainly some performance there from the dividend perspective. We're also reducing the number of shares outstanding. We'll show that to you when we get to cash flows. Now, in terms of the balance sheet, everything looks pretty good. Okay, cash is still there. Cash has left the building over at Walmart, and I'll show you where it's gone primarily because look, last year they had over $22 billion. Back in January, they had $14 billion. We're talking about just straight cash. Now that's all the way down to about 11.8. Not a lot of it is rolled over into receivables, although year over year receivables are a lot higher. Look what's a lot higher because look at your total current assets all the way up to 83 billion. Last year you're at 76. So you really reduced your cash. I mean, your cash almost got cut in half over at Walmart. Well, look what happened to inventories. You went from 46 all the way up to 61. So Walmart's well positioned on that inventory side, but we showed you through the cost basis, they're not necessarily necessarily making a ton of money off of that inventory. I noticed their inventory is up over January as well. Could be a good sign. I tell you what, if Walmart has strong back half demand, they're obviously sitting well from an inventory perspective. If consumers really pull back on their wallet, which I tell you what, if they're not shopping at Walmart, will be devastating for the entire economy. Well, Walmart's pretty well positioned, okay? They've got far more inventory than they did back in January and way more inventory back in April. But whenever you see cash go down like this and inventory tick up like this, you better believe when we get to cash flows, there's going to be a lot of cash flow burning out of that side of the business. Now, from the liability side, we noticed that our long-term debt year over year went from 40 billion down to 32. That's a positive, but you always want to come up and see if a lot of it or some of it's been rolled over to short-term borrowings, and it looks like maybe some of it has. We'll see the full evidence when we get over to cash flows, but they have reduced their long-term debt, but I think some of it rolled over here to kind of short-term borrowings. All things being considered, balance sheet's not bad. They've bled through a lot of cash over at Walmart. They've piled a lot of it into inventory, and assuming that inventory gets moved through over the next 2 or 3 quarters, probably a good sign for Walmart. Now, in terms of the cash flows, not a great picture, okay? We pulled down a net income number of about $2.1 billion. Talked about how last year was a little bit better than that, about 25% better at $2.8 billion. Company has a fair amount of depreciating assets, about $2.6 billion year over year, but we talked about that inventory line. Look at last year, you're at 1.5. This year, all the way up to 4.7. That's like over a 3-fold increase on that inventory expense line. And notice what it did to our cash flows. It blew them up. You went from positive cash flows last year at 2.8, negative cash flows. You don't see this that often with Walmart. Negative cash flows in the most recent quarter at $3.7 billion. Again, the vast majority of that, I believe, is driven by the fact that they invested heavily into this inventory line, because all things being considered, every line across the board is about where it was a year ago, except for this inventory line that really flipped around and that killed the cash flows over at Walmart. So if you believe back half, Q2, Q3, Q4 sales over at Walmart will be strong, maybe their value proposition will really resonate with consumers that are paying $6. I saw $7 gas out here in California yesterday. Certainly could be something to think about. Now, the company continues to invest in property, plant, and equipment, up from 2.2 last year all the way up to about $3.6 billion. So we had another 4.5 bleed out of the company from investing activities. You come down here, you see net change in short-term borrowings, about $11 billion. We did repay a small amount of long-term debt at about $926. So it looks like most of that long-term debt reduction that we saw here on the balance sheet just simply rolled this over into kind of a shorter-term borrowings. We did pay some dividends, and we bought back some shares as well, about 2.4, although that was a little more accelerated last year on a quarterly basis at about 2.8. So you see the company generated by increasing those short-term borrowings, generated about $5.3 billion worth of cash, but they bled through over $8 billion of it operating the company. So they burned through about $3 billion in the quarter. Last year, they generated over $3.2 billion. So there's certainly some investors that are digesting these numbers. Now, in terms of the different business units that Walmart operates under, we see that from a net sales perspective, Walmart US still doing okay. 4% growth on that revenue side. We see here on the operating income side, though down 18%. Again, that inflationary pressure really showing through, but we're really seeing the international market. We saw this also with Amazon as well. Real big decline on that sales side, 13% decline on those sales, Walmart International. And we also see big hit on that operating income side, down 35%. So still profitable, but down big. And then the Sam's Club as well, up 17.5% on that sales, but also operating income taking a hit, almost identical to where you were at the Walmart US stores, down about 18, 19, 20%. All things being considered, not a great quarter for Walmart. Could tell us some things about the broader economy when Walmart is not doing well. I tell you what, there's going to be a lot of retailers and a lot of discretionary stocks that are probably still going to continue to get hit in these markets. Now, from a technical perspective, this, in my opinion, is a fantastic place to buy Walmart. You have the bottom of the range, which is right here at $135 per share. That has been the bottom of the range since about August of 2020. So we're nearly going on 2 years. Well, Walmart has found a bottom at this 135. Now it's peaked through. It's spent a couple of days below 135, but in general, it has not. Now, the top of the range is not much higher than where it is. It's up here at about $151 per share. And quite frankly, when Walmart gets to the top of the range, not necessarily the worst time to take profits if you want to. Now, from a longer term perspective, this almost looks a little bit like an Intel chart as well. Still, from a longer term perspective, despite basically going sideways over the last 2 years over at Walmart, longer term uptrend, which really started kind of in the end of 2015, kind of the start of 2016. So we're looking at like almost a 6-year uptrend in this stock. This level also should provide a little bit of support. You have a little bit of support from a technical perspective at 135, a little bit lower than that. You have this longer term uptrend, which is still intact over at Walmart. I added a couple of shares at about $135 per share today on Walmart. You get a little bit of a dividend. You get some dividend growth. You get the benefit of these share buybacks as well. You're not going to see strong revenue growth over at this company. They're not going to necessarily reaccelerate these to kind of like high single digits or low single digits. You should have some tailwinds at some point from the economy and cost easing at some point. That certainly will benefit Walmart. Certainly not going to be one of these high-flying stocks with a high beta and a high risk reward, but you get that dividend, you get that dividend growth, you get that share buyback, and you get a little margin of safety when you look at this stock from a longer term perspective. Over the last 5 years, up 80%. Over the last 10 years, up 107%. Again, not a stock in the cornerstone of your growth portfolio, but certainly can be that area of your portfolio that's a little more conservative and can perform in just about any environment. That was Walmart. Hopefully you guys enjoyed today's video. I'll be back again soon with more. Good luck with your investments.